When talking about real estate investment, most people would think about a home purchase, a development, or some form of direct ownership. However, there are still ways of getting exposure to the property market aside from the direct ownership route. There are 4 types of real estate investment, as shown in the 4 quadrants. There are private and public investments. Then in each of these 2 categories, we have either equity or debt investments. So in summary, there are 4 types of real estate investment: private equity, private debt, public equity, public debt. Let's start with private real estate investment. Private equity. Private equity investments are normally suitable for investors who can tolerate low liquidity. Most private investors are institutions, such as pension funds, private equity funds, or developers. The time horizon could vary from medium to long term. A developer, for example, could develop the site and sell the asset to a long-term investor, such as a pension fund at point of completion, or PC. Pension funds normally hold the asset for a long period of time for income. Private debt. After the financial crisis, there has been a reduction in the traditional banking lending, so private debt funds have emerged and are now growing as a new asset class. Private real estate debt funds tend to have private equity-backed capital with mandates to provide mezzanine and senior debt to commercial borrowers. The second category is public investment. This includes public equity and public debt. Public equity usually involves investing in REIT stocks. REIT stands for Real Estate Investment Trust. REITs are public real estate companies which directly own and manage properties. How they differ from private equity real estate funds or pension funds is that they raise capital publicly. You can choose to invest in REITs by buying their stock the same way you invest in any public non-real estate companies. The benefit of investing in REITs is that it is a lot more liquid than traditional direct investment. You can get exposure to certain markets. For example, you can choose to invest in a REIT with portfolios concentrating in London office market. That gives you exposure to the London office market without having to acquire properties, which requires a lot of capital and involves high transaction costs. To qualify for a REIT status, at least 75% of a company's profit must come from property rental. REITs also have to distribute 90% of their income as dividends to investors. The advantage is that they don't have to pay corporate and capital gains tax. Depending on your appetite and investment preference, you can purchase shares from different REITs. There are some REITs which hold diversified portfolios, like British Land in the UK. British Land hold a broad portfolio of retail, office, and residential assets. REIT stock have both stock-like and property-like characteristics. On the one hand, the performance of REIT stock is correlated to the underlying asset. At the same time, they behave like stocks and respond to market sentiments. Public debt. Public debt involves investing in securities the companies lending in real estate market. An example of real estate public debt is mortgage-backed securities, which some of you might have heard of. Public debt or mortgage-backed securities behave in the same way as both the property market and fixed income. Your income stream is tied to the underlying mortgage payments, which is similar to how you receive coupon payments in bonds.